Hi, this is Todd Baker, and I am here with Jake Baxter, who is with ARC Mortgage, and they are our investor for alternative documentation loans. And what we wanted to do is put together a summary of what these loans are, when to use them, and how important this is to you, because according to the Federal Reserve, just this last year in 2023, the average homeowner's net worth was $396,000. The average renter was only $10,000. And what we found is since the housing crisis, the whole mortgage industry was re-regulated, and a lot of the people that were self-employed or independent contractors, or maybe had assets, but not a lot of income, were suddenly unable to continue to buy real estate. And that represented like a huge slice of the market. And so what's evolved and developed are these alternative documentation loans. And they're great loans, they're great products, and allows you as a client to now buy a home. This video is for you, my clients, my pre-approved clients, anyone I've ever spoken to, realtor partners and builder partners, to use this as an understanding of when you want to approach us with this type of loan. So there's four basic types that we're going to talk about: a bank statement, 1099, asset utilization, and then a debt service coverage ratio for investment properties. So Jake, take it away. Give us just a snippet of each one of those programs.
Absolutely, Todd. So yes, thanks for having me on. Let's just go down the list. So first, bank statement loans. This is going to be for self-employed borrowers. Instead of looking at tax returns, which are often dated, or there's a lot of write-offs, we're looking at bank statements. We're looking at bank statement deposits from either personal or business bank statements to come up with income. We feel that as an organization, the bank statements show a more current view of the business's financial picture than tax returns that could be a year plus old, stale data. So that's one document type. The next is for 1099 borrowers. This is your contractors, real estate agents. I see salespeople, attorneys, doctors. I mean, it could be folks from all walks of life who are working as 1099 individuals. These folks are still self-employed and oftentimes write off too much on tax returns, which doesn't allow them to qualify for maybe as much house as they'd like. So we take a more aggressive approach by just looking at the 1099s, avoid looking at tax returns, and oftentimes this ends up allowing them to qualify for more house, and it's a lot less documentation involved than your normal conventional or Govy underwriting look. The third one is asset utilization. This is your borrowers that may be flush with assets, and it doesn't have to be somebody that's a multi-millionaire. Again, all walks of life. They just may not have enough income on tax returns. Maybe it's somebody who's newly retired. They're not taking distributions. They don't want to take distributions from retirement. Maybe it's someone who recently sold a business. So from conventional underwriting guidelines, if I just sold a business, my income stream is now gone. So what do? Well, those assets from the sale of my business, they count for something. And that's kind of where we come in. And then the last thing you mentioned, DSCR, stands for debt service coverage ratio. This is for investment properties only. This could be for first-time investors, seasoned investors. Our focus on that product is just the cash flow of the subject property. So we avoid calculating debt to income ratio. I don't have to verify employment or income. I only focus on the income that the subject property is going to bring in.
That's great. So could you tell us now, go back to the same four, on bank statement, the range, the expense range, in other words, like the percent normally income, and do the same for the 1099, how the brief calculation on asset utilization, and what's used to determine income on the debt service coverage ratio loan?
It's a great question, Todd. I oftentimes compare the two because they are similar in certain ways. So let's take bank statements first. Again, I'm going to look at all the deposits in 12 to 24 months of that individual bank statements, either individual or business related bank statements, and I'm going to haircut that. And we're going to haircut that based on the type of business and how many employees that business has. And that could range anywhere from 20 to 60%. We call that an expense factor. So I'm going to take 100% of deposits, I'm going to cut that back by 20 to 60%. On the other end of things, the 1099 individual, your contractor, we're going to take 12 or 24 months of their 1099s, and we're going to only cut it by 10%. So not only is it far less documentation than getting 12 to 24 months of bank statements, because I'm only looking at 1099s, my income calculations are far more aggressive as well.
All right, so tell us, and then on the asset utilization, is it you take the assets and you divide them by 60 months, and can you use that for like 401k or the Roth IRAs? Like tell us a little bit about how that works.
Sure. So as I've mentioned in our previous videos, there's no age restriction on this product. Oftentimes folks feel or think that in order to qualify on assets, I've got to be of retirement age. That's not the case. We're going to take the assets and we're going to categorize them based on retirement, non-retirement, and cash assets. And then we're going to back out down payment and divide that by 60 months. Whatever that number is the income that we're using for asset depletion. Now that income can be used as a standalone source of income, or it can be used in conjunction with other types of income, full doc, bank statement, whatever it may be.
That's great. And then for the DSR, you're going to use the lease on the house if it has one, or do you go off of what the appraiser did? Like the appraiser would do a rent survey when they appraise it. What do you use for investment property?
We look at both the lease and market data. So we're going to get an appraisal, obviously, on all transactions. An appraisal is necessary. DSCR, we're going to get an appraisal with a rent schedule, and we're going to compare market rents to whatever the property is leased for, and we'll use the lesser of the two. Now, let's say the property isn't being leased. It's vacant. That's okay, too. We're going to revert to market rents in that scenario.
And then what's the ratio? Do you have to have like 100% coverage, or is there a ratio for that?
No. So we allow up to 80% LTV, so 20% down. In that case, we do want it to hit what's called a 1-to-1 ratio. I want my rental income to fully cover my housing expense. I do allow a negative cash flow situation where rent is actually less than my housing payment. In order to qualify for that, I'll need 30% down, and we'll only allow negative cash flow down to 0.75. So what does that mean? If my mortgage payment for easy math is $1,000, PITIA, all in, I'm $1,000, I need rent to be at least $750 to qualify for a negative cash flow product.
Got it. So just to add some flavor to that too, for those of you looking at investment property, you're going to put 20 to 25% down on a conventional loan anyways. So you're going to be 20% down, but the documentation is really cumbersome, where this is just if your rent's covering your payment, you're pretty much good to go. So this is a great segue to talk about something that comes up sometimes, but alternative documentation, that's interest rates. And you and I actually went over this before this call to look at what we call the spread. And that was what's the difference between a conventional and an alternative documentation loan for like a high FICO, a really good borrower, just like what's the difference? And really it would be the same for any borrower, right? Like what's the difference comparing apples to apples? As of this, I just went online, looked at Mortgage News Daily. Right this second, their daily index average was 6.78. And most lenders for conventional loans, which is Fannie Mae, Freddie Mac, it's 6.875, but it's with 2 discount points, which is prepaid interest. And I know you guys are going to be real comparable to that, but what's the actual spread? Tell about it, because it's not like this huge difference like people might imagine.
Yeah, the difference between conventional pricing and what you see on these alternative document products is anywhere from 0.75 to percent. Obviously, that could vary based on the borrower's qualifying factors, the property, down payment, these data points we look at to come up with a rate. But you're not seeing 4 or 5% difference with a massive amount of fees and aggressive lending practices. The spread is minor in comparison to what you may have seen in years past.
Yeah, so that's a super big takeaway too, is to understand that if you're watching this video, you don't buy a house based on interest rate. You don't manage your mortgage based on interest rate. You don't even select a mortgage company or a loan officer based on interest rate. If that's their value proposition, what they've just told you is they don't have anything to offer you. That's really what's happening. You base your decision to purchase a house on how it fits into your personal financial plan. So what I do is I don't care about the rate, because you're going to get wherever market rates are at. If you go with a conventional loan, you're going to end up getting like a conventional loan rate. If it's a government loan, you get a government loan rate where it's at right then when you buy. And the same thing with alternative documentation. So the point is that I started this conversation with the Federal Reserve's net worth analysis, and I want to end it with that too. That's why you're buying a house. You're buying a house to create wealth, and for owner occupied, to have a home and security for you and your family that also happens to be an asset. It's the ultimate thing, which is why it's called the American dream. And the right plan is the one that fits it into your personal financial goals over 5 and 10 years, but also your current situation vis-a-vis your cash on hand, your cash flow, etc. That's how to do it. So regardless of if you need an alternative documentation loan, I can build you the perfect plan that fits into your budget and be very comfortable and help you start to build that wealth and take advantage of a market right now. Then in the first quarter, there's still opportunities to negotiate with sellers in most cases. So hope you guys all found this helpful. Jake, thanks so much as always for helping out. Hope everybody has a great day.
Thanks, Todd.